PowerPoint presentation available there for download too. So take it away, Darren.
Hi there, greetings. Thank you very much, Chuck, and thank you one and all for joining us for this program dealing with coverage and non-discrimination testing. We'll be running, for 100 minutes. Please feel free, if you have any questions, please feel free to post them as we go along. Here's what the outline is. We'll start with some basic principles. We will look at some of the strategies that exist in terms of plan design, because there are a number of different alternatives to look at from the design stage. Before we can get into the mechanics of coverage and non-discrimination testing with related employers, we have to look at some preliminary issues like compensation and HCE status. And then we'll go into specifically coverage and minimum participation, ADP, ACP testing for deferrals and match, and non-discrimination testing per se under Code Section 41A4, including cross-tested plans. The basic principles. There are a variety of ways to have related employers. I use the phrase related employers to describe all of these. A control group, any of the various flavors of control group, a group of trades or businesses under common control, which includes both the things that look like control groups, except they have partnerships and LLCs taxed as partnerships and sole proprietorships. The typical things that we think of in terms of common control. And it also includes the special rules that have been with us. Oh, you know, the IRS issued the regs in 2007. They went into effect in 2009, but special rules dealing with tax-exempt organizations where you don't have ownership, and we use overlapping boards and control of the board as a substitute for ownership. Also, you have traditional affiliated service groups involving A orgs and B orgs, and management function groups where you have not necessarily any common ownership, but you have two entities that are related because one has as its primary business purpose performing management functions for the other entities. So we've got code sections 414B, C, M2, and M5 all represented here on the screen. And as far as coverage and non-discrimination is concerned, in fact, as far as most issues are concerned, which one of those specific code sections you run into really doesn't matter. They are all treated as related employers, and the consequences for coverage and non-discrimination testing are the same. There are a few incidental differences, with the most important of those differences being in deduction. You have some real differences in deductibility between controlled groups and affiliated service groups. But other than that, for the most part, the consequences are the same. Those consequences are that all employees of all related employers are deemed to be employed by a single employer for really most retirement plan purposes. And I gotta say, that's all 414B, C, and M say. Is it says for these purposes, and you have a list of code sections, all employees of these related employers are deemed to be employed by a single employer. That is to say, the control group rules in and of themselves do not say, oh, and if any of them sponsors a plan, they have to cover everybody. They don't say that. They don't need to say that. They say, for purposes of these code sections, all employees of all related employers are deemed to be employed by a single employer, and then they leave it up to those code sections to tell you what to do from there. So they don't have to say, oh, there's a single 415 limit for all related employers. They just say, for purposes of Section 415, all related employers are treated as a single employer. And then I go look at 415, for example, and it says, well, if an employer sponsors multiple plans, we will add those plans together to determine whether they comply with Section 415. In other words, the strategy Congress has come up with, and it's a reasonable, appropriate strategy, is to say, we're going to tell you what entities you have to treat together, and then we're going to leave it up to the regular rules, 410B, 401A4, 415, 416, to tell you what to do from there. But the code simply says, we'll treat them as a single employer, and then you go look at these other rules to say what you do from there. Well, included in this is crediting service for eligibility, vesting, and benefit accrual, as well as coverage and non-discrimination, and the exclusive benefit rule. All of those are things for which the entities are treated as though they were a single employer. Well, what does that really mean? Well, there are two key questions, two key perspectives that could enter into play. When I'm looking at it from the employer side or from the plan side, I frequently have to ask, who are the employees of this employer? For example, when I'm doing coverage testing, one of the first things you come across is I've got to count my employees, and then I exclude the people that I can exclude. But first thing I do is I count my employees so that I know how many Hileys, how many non-Hileys I have to count. Whether they're benefiting or not, I have to count them. So when we're doing that count, when we're asking who are the employees of this employer, we're looking across all of the companies. So, for example, suppose companies A and B are in a controlled group, and company A sponsors a plan, and the employees of company B are eligible to participate in the plan. That's not my favorite way of doing things, by the way, but it's certainly a possibility. Well, one of the things for which they're deemed to be a single employer is the exclusive benefit rule. So you ask, all right, company B doesn't sponsor this plan. Aren't we violating the exclusive benefit rule by covering this employee? And the answer is no, because the two are deemed to be a single employer. Now, that's from the standpoint of the employer and the plan, but sometimes we have to look up from the standpoint of the participant. From the standpoint of the participant, the question is, who's the employer of this employee? And the answer is all of the various entities are treated as one employer of this employee. For example, you ask the question, has the employee severed employment? Well, if they've gone from company A to company B, and A and B are related employers, no, they haven't. And if they go from company A to company B, let's say you have the company A plan has a 6-year graded vesting schedule, and somebody moves who has 4 years of service, goes from A to B. Let's assume the B employees don't participate in the plan, but we have somebody who's gone from company A to company B. In the process, have they severed employment? No, because it's all considered one employer. Does the service with company B count for purposes of crediting vesting with company A? Of course it counts. So even though the participant may not be accruing any further benefits, they would be accruing vesting service, which could impact what is there in that plan. The related employer rules do not explicitly say what employees do you need to include, but they don't need to. 410B does a fine job of that. But they say, for these purposes, who are the employees that we have to consider? The easiest way to deal with most related employer questions, including how do I do coverage testing, how do I do non-discrimination testing, is to forget that it's a control group. Instead of saying, I've got these two different companies that I'm treating as a single employer, say, I have one company, and it has an office in San Francisco and an office in Los Angeles. How would I test the plan if they have an office in Los Angeles and an office in San Francisco, and only the Los Angeles employees are able to participate? When I phrase the question that way, people almost intuitively know what to do from there. They know how to handle that particular situation. Well, that's what the related employer rules do. They say, ignore the fact that this may be two companies. Pretend it's one company. What would you do? And usually, if you understand the answer to that question, you understand where to go. I give a lot of presentations that focus on analyzing control groups, affiliated service groups, groups of trades or businesses under common control. I've given a lot of those presentations over the years. This presentation is really step 2. We're a related employer, so what? But I give a lot of presentations that are step 1. Let's figure out what employers are related. And inevitably, once I'm done with that presentation, I will have someone come up to me and say, companies A and B are in a controlled group, and company A sponsors a plan. I've got to cover the employees in company B, don't I? And I will put it back to them in that Los Angeles, San Francisco example. Suppose I have a plan with an office, a company with an office in Los Angeles, an office in San Francisco, and they have a plan just covering the employees in Los Angeles. Can they do that legally? Can they just cover the employees in Los Angeles? And almost right away, the person will give the correct answer. Well, yeah, if they can pass coverage. Actually, the correct answer is if they can pass coverage and non-discrimination. We'll come to that in a bit. If it's a defined benefit plan, we also have to pass minimum participation. But the key thing that comes out is, first and foremost, they have to be able to pass coverage. And yeah, that's the test. But if you can pass coverage, you're good to go. Now, let me add a caveat to this. If you're talking about a SEP, if you're talking about a simple IRA, if you are talking about a standardized plan, any of those, you have a document that says you must cover all employees of all related employers. You're stuck with that. That's what the document commands you to do. And if you fail to do that, you have an operational failure, and the employer is going to have to pony up money to fix it. It's just that simple. But if you have a volume submitter document, a non-standardized prototype, if now it's simply a non-standardized document now that they've combined the two programs. If you have an individually designed plan, can I have this design? Sure, if I can pass coverage and non-discrimination and minimum participation. But that's the key thing. So let's just try one with a standardized plan where I do have to cover everything together. This example has happened. This is not a pure hypothetical. This has happened. Companies A and B are related employers. In fact, anytime I mention my good friends, companies A and B, they are always related in this program. A has sponsored a simple 401k on a standardized document since 2005. B does not co-sponsor it. In point of fact, the TPA that is working with Company A has no idea that Company B exists until this year, when they find, to their horror, that Company B exists and has a whole bunch of employees. The document, by its terms, covers the B employees. So, and you see the bullet there, this is not an exclusive benefit rule violation because the two are treated as a single employer. Do we have a problem? Heck yeah, we have a problem. The problem is that the two are treated as a single employer. The plan says you're including the employees. This is a simple 401k. You haven't given people the opportunity to defer. You haven't made a non-elective contribution if it was a simple non-elective. You have failed in complying with the plan terms. This is an operational failure. Is it a significant failure? If it is a significant failure, and my goodness, a failure like this going back to 2005, it's really hard to say it isn't a significant failure. How do you fix it? The first thing you got to know about fixing this significant operational failure is you're way past the point of self-correcting it. So you have to go in under VCP. Finding the data, figuring things out so you can do the correction is not going to be easy from a practical standpoint. Being able to go in under VCP and talk about, gee, here's our problems, here's where we're going to need to bend the rules a little to get things right given what we've got. VCP can give you a lot of comfort there. But we're going to have to put in makeup contributions for the missed employees and make things right. And that's the way one would fix it if one chose to fix it. But that would be the way to do so. So let's talk about some of the alternative approaches that are available to dealing with related employers in terms of plan design. Suppose companies A and B jointly adopt a single plan covering all eligible employees of both companies. What's good, what's bad about that? There's a lot to like about that. It certainly is easy to understand. It is easy to put in play. You have one document to keep up to date. You have one pot of money to administer. The fact that it is just one pot of money may be cheaper or it may be more costly. It may be cheaper in terms of economies of scale. It may be cheaper because you have only one 5,500 to prepare. But it may be more expensive if the two plans separately would each be under 100 participants, but the one plan together is over 100 participants, and therefore you need an audited 5,500. One of the nice things about putting everybody together in one document is that it really simplifies testing. It makes the administrator's life much easier. A disadvantage? You lose some flexibility in the process. You could be in a situation where what I'd really like to do is have an ADP tested plan for company A and a safe harbor for company B, because the B employees really don't defer and the A employees do just fine. So I would really like to try a different approach for the two companies. I pretty well lose that if I have a single document, but there are a lot of compensating advantages. So this is a perfectly good strategy, and it's the first one people look at as they consider dealing with related employers. My recommendation: this is not a qualification issue. This is a deduction issue. My recommendation is that each employer computes its own share of the contribution and contributes its share of the contribution for its employees. The reason I make this suggestion is that you could have a deductibility issue. There have been court cases that say it's not an ordinary and necessary business expense for Company A to be providing retirement benefits for the employees of Company B. And from a deduction standpoint, it is safer and simpler to have each of the adopting employers kick in for their own employees. As I suggested earlier, if you're dealing with an affiliated service group, each employer computes its deduction limit separately. So you could have a situation where you would exceed your deduction limit if one of the companies chips in for everybody. This is, I think, the first approach, the one that you're most likely to look at first. Next possibility: Company A adopts a plan covering the employees of both companies, and B doesn't co-sponsor the plan. Well, I still have a single plan, so I have reduced expenses there. I still have a single 5,500, but I have some intriguing deduction problems. One is the ordinary and necessary business expense. Two, let's say it's a control group. So I don't have the affiliated service group issue, which is that each employer computes its deduction limit separately. With the control group, you've got one deduction limit, except if you only have one employer adopting the plan, that deduction limit is going to be based on the employees of that employer. And it will not take into consideration the employees of the employer in calculating the limit, the employees of the employer that is not sponsoring the plan. So you have some really very major deductibility issues. Moreover, if it's a 401k, as a practical matter, Company B is going to have to be involved in terms of withholding the deferrals. So I don't view this as a practical / good solution. I don't see that it offers you anything that is better than the first alternative. What we see frequently is that Company A adopts a plan for its employees and Company B adopts a plan for its employees. Well, now I certainly have additional expense. I have two plan documents to maintain and administer. I have two separate Forms 5500. Assuming that I have two pots of money, I have two 5500s. Now, that looks like additional expense. However, if the two 5500s are not audited and one would be audited, it is a very real savings. The nice thing about having separate plans is that it allows you different approaches for the two employers. At this point, you have to be concerned about passing coverage and non-discrimination. Either you have to have a situation where each plan can pass coverage and non-discrimination on its own, or you have to be able to permissively aggregate the plans in order to test it as a single plan. Either approach can work. Either they can each pass separately, or you can permissively aggregate the plans. But if you want to go with permissive aggregation, that's going to put some design shackles on you. That's going to limit some of the choices you have in setting up the two plans. Permissive aggregation, I love the option because it is very flexible. I can use it some years, not others. There's nothing that has to be in the plan document per se, so long as the documents are designed in a manner to permit permissive aggregations. That design includes the fact that they have to have the same plan year end. I cannot permissively aggregate two plans that have different plan year ends. They also, for 401k purposes, have to have the same testing method. So, in other words, they both have to be current year tested, or they both have to be prior year tested. They both have to be safe harbor non-elective, or they both have to be safe harbor match with the same rate of match. In order to permissively aggregate it, those key 401k features have got to be the same. Now, those items are mandatory. The ones on the right of the screen are optional but extremely helpful. One is that you have similar benefits, rights, and features. Once I permissively aggregate the plans, they become a single plan for purposes of benefits, rights, and features. For example, suppose Plan A is self-directed investments, and Plan B is trustee-directed. If I permissively aggregate the plans, and hey, why am I permissively aggregating them? Because either I'm not going to pass coverage or ADP if I break them up, right? That's why I'm coming here. Is I need it so I can pass testing. If I permissively aggregate the plans, and I know ahead of time I don't pass coverage if I don't permissively aggregate them, that could create a problem once I go to aggregate them. So having similar investment strategies, for example, between the two plans is helpful. Not mandatory. I may be able to pass benefits, rights, and features, but it's at least an issue to consider. Having different vesting schedules between the two plans is okay. That is not, because vesting schedules are not a benefit, right, or feature. It is helpful, not mandatory, to have the same eligibility requirements. Why do I say that? Suppose Plan A requires 6 months of service, while Plan B requires a year of service. When I do coverage testing on the A plan alone, I divide employees into two groups. I have the people who don't have 6 months of service and say, you know, you go out of the room. You're not involved in my testing at all. I'm not thinking about you guys. And then I have the people who have 6 months of service, and I say, all right, you people are benefiting, you people aren't. Let's run a coverage test. I do the same thing with Plan B, except the dividing line is a year of service, right? Well, when I permissively aggregate the plans, what I get is one plan that has two different sets of eligibility requirements. And effectively, I have to use the most generous. I have to use whoever could satisfy either set counts. So what I've effectively done is said, even at company B, I'm going to at least count you for coverage if you have 6 months of service. So while it's not mandatory as a design thing, this could just come up as testing. I think it's helpful to have the same eligibility requirements if I want to keep the door open for permissive aggregation. I don't have to keep this door open, all right? I mentioned earlier the possibility Company A has an ADP tested plan, Company B has a safe harbor plan. That's perfectly viable, but I know right away that's going to fail this rule. That's going to fail the requirement that they have the same testing method, which means I will not be able to permissively aggregate. That's not the end of the world. I've got two bullets here. One is that I permissively aggregate. The other is each plan separately passes coverage and non-discrimination.
Darren, we have a question that I think illustrates a lot of what you're talking about, and might be able to interject at this time if it's okay with you.
Fire
away. A sole proprietor has a solo 401k plan, also owns 80% of a C Corp, which has a safe harbor 401k. But he is not an employee, does not receive any comp from the C Corp. There are a lot of assumptions buried in there, and I'll let you unpack them, but the question is, must the plans be identical as to provisions and contributions?
Okay, excellent question. So we've got the solo K that just covers the owner, and then we've got this corporate plan. The two are a control group or under common control. We've got this corporate plan which doesn't include the owner, but does include a whole bunch of employees. Let's just look at the solo K plan. It has the one participant, the owner. It excludes all of the employees who are in the corporation. Tested alone, the solo K plan will fail. Unmistakably, it will fail. So the only way that all right, again, suppose the office in Los Angeles only covers the owner, and the office in San Francisco has only the employees, and I have a plan just for the owner and excludes all the employees. Can I pass? Of course not, unless I permissively aggregate the plans. But if I want to permissively aggregate the plans, I have to have the same plan year, and I must have the same testing method. So they both have to be, for example, safe harbor plans for this to work. And as you go through to the other side, let's suppose the plan for the owner allows distributions at age 50. Let's suppose the plan for the employees doesn't allow distributions until you separate from service. So we now have a distribution option in these two aggregated plans that are going to be treated as a single plan. We have a distribution option that is just available for the owner of the company. That's a dead bang loser in terms of benefits, rights, and features. So as a design matter, you take all can you still have the solo K? Yes, and there's still reasons to have it. For example, you could have different trustees for the different plans. There might be a number of reasons why you would want to separate them out. But on these facts, I could have a very real benefits, rights, and features issue. If there are different investment options, different distribution options between the plans. If I had a situation where the owner could borrow, but the employees couldn't, that's a feature, and it would fail 401A4 if I have to permissively aggregate the plans. Tim, would you the other disembodied voice you heard there was friend and colleague Tim McCutcheon. Tim, would you like to add anything to that?
No, and to the question, must the plans be identical? The answer is no, but since the solo pay only covers a high, the features in the solo pay must basically be less favorable than the feature, all of the features in the solo pay that would constitute a benefit rider feature or other thing that has to be tested must be less favorable than what's in the plan that covers
the same or less favorable. Yeah. Excellent. Any other questions at this point?
Let's see. This is a question that we get a lot. If Company A and Company B were related, Company A, let's see. Okay, I'm going to change the facts here a little bit. Let's say that Company A and Company B are a part of a group. Both Company A and Company B have plans. Somebody transfers from A to B.
Yeah.
What happens?
All right. So I move from A to B. I haven't severed my employment. Now I look at plan terms. Let's assume that the A plan says only employees of A participate. And so at that point, the individual becomes an excluded employee for that plan. But they walk in the door with their service intact when they come into the B plan. Let's suppose this employee has been at Company A for 4 years. And they walk to the office across the street. They're now in Company B. They walk in the door with 4 years of service. When did they enter the plan? Immediately. They have 4 years of service. They already passed their entry date. They entered the plan immediately. You don't have the option to make them wait for an entry date. They walk in with 4 years of service for purposes of vesting. Their compensation for purposes of top-heavy, and we'll get to this in a moment, and a bunch of related issues, is the comp from both companies for the entire year. You don't have an option about that. Their compensation for purposes of allocation, now I'm going to direct you to the plan document. Some documents say we're going to count comp for allocation purposes from throughout the control group. Some documents say we're just going to count your comp from Company A. Either's legit. We'll talk about the aspects of that in a moment. Can I transfer the money from the A plan to the B plan? If the document permits it, absolutely, and you probably want to. Do I have to? No. Tim?
Okay, here is a little bit of a subtle one, and I'm not sure you covered it. It's you have 2 plans you must aggregate. Both are safe harbor plans, and both have a match.
If you're talking about the HCE aggregation, I'll get to that.
Okay, no, this is safe harbor. So let's say you have two safe harbor plans, and you want to aggregate them. But for whatever reason, they have slightly different matching formulas.
The problem with that, if I permissively aggregate them, they become tested as a single plan. And the rule is, for a safe harbor match, there cannot be any non-highly under the plan, and I've aggregated them so it's one plan. There cannot be any non-highly in the plan who has a rate of match less than that of any highly in the plan. So if one is a basic match and the other is an enhanced match, and there is any HCE with the enhanced match, I cannot permissively aggregate the plans because I would blow up the safe harbor, because the employees with the standard match wouldn't have it. Now, what I can do is I would have to amend the basic match plan to increase the rate of match to that of the enhanced match. But that needs to be done at least 3 months before the end of the year, and it has to be retroactively effective to the beginning of the year. And it is, and I don't see that as being something I can do at the end of the year in the process of permissively aggregating the plans. So when I say it's the same safe harbor contribution method, it not only includes the distinction between a safe harbor non-elective and a safe harbor match, it also includes the difference in the rates of match within the plan. The rate of match in the two plans has to be the same.
Okay.
Other questions?
Actually, we've got a very large number of questions on this topic. I'm not sure we really have the time to go through all of them. Any recommendations on what we should do with the questions that we don't have a chance to answer here during the webcast?
The answer is we can answer them all and post the responses and come back next week, and we will have the answers posted online. How's that?
Okay, perfect. Thank you.
Continuing on. We have plans. Company A adopts a plan for its employees, and Company B doesn't have a plan. Perfectly viable, so long as you can pass coverage, non-discrimination, minimum participation on that basis. Perfectly viable approach. And it could be very well that the Company B employees, really wouldn't care. They would rather have money now than money later. Well, if I can pass, happy day and hallelujah. Let's go to the issue of compensation, which I alluded to earlier. There are a bunch of different definitions of compensation, and you have different results in different places. Our starting point is Code Section 415. That is our definition of total comp. And the regs are extremely clear. Total comp includes all comp from all related employers. So, for example, Jack works for both companies A and B. Each pays him $40,000. For the year, he has $80,000 in comp for anything where we are looking at total comp. And this includes the 415 limits, top-heavy minimums, determination as to whether Jack's a key employee or a highly compensated employee, minimum 5% and 7.5% minimum gateways. He has $80,000 in comp. So suppose Company A has a plan just covering the employees of Company A, and it turns out to be a top-heavy plan. For purposes of computing Jack's top-heavy minimum, he has $80,000 in comp. His top-heavy minimum defined contribution is 3% of $80,000, $2,400. No choice about anything on the screen. Next, we come to non-discriminatory comp under 414S. This is the definition that we use for testing, where we have to have a non-discriminatory definition in order to do our ADP or 4184 testing. Any of the total comp definitions automatically are non-discriminatory. So that means counting comp from all related employers. But if we want to, we can roll our own definition and come up with some other definition, and we can use it as non-discriminatory comp if it's either safe harbor or it is reasonable, it doesn't discriminate by design, and the key one is we pass the compensation ratio test every year. Well, so I have my definition of comp is I'm going to just count the comp from company A, and that's the one I want to test with. First question, is that a reasonable definition? I would think it is. You know, it's hard to see the IRS particularly arguing that point and saying, no, this isn't a reasonable definition. I think they're going to go with that. So is that reasonable? Yes. The real question is, does it pass the compensation ratio test? Does it knock out at least as much comp for the Highleys as it does for the non-Highleys? And that, unfortunately, is something you're going to have to test every year, because this is certainly not a safe harbor definition. For allocation purposes, you don't have to use a non-discriminatory definition. The document has to tell you how you're going to allocate. So the document defines compensation for allocation purposes. And you go from there. Having said that, I don't need absolutely to have a non-discriminatory definition of compensation. The fact of the matter is, if I don't have a non-discriminatory definition for allocation, for non-elective contributions, it's going to force me into the general test. That may not bother you. You know, you may be doing cross testing, and you're going to do the general test anyway. But at the very least, you have to think about this fact. It could create a situation if your definition of comp turns out to be discriminatory. It could create a benefits, rights, and features issue with regard to the rate of match. Let me just specify, give you an example. So companies A and B are related employers. A has a 401k plan with a match and says we're only going to look at your compensation from A in calculating your match. If it turns out that just looking at comp from A is a discriminatory definition, I have to test the rate of match for benefits, rights, and features. But can I set up a plan that considers comp from only one employer? Absolutely. And for many documents, it's a checkbox option, but it's a checkbox you have to consider carefully. But could you have a situation where A and B jointly sponsor a plan and A contributes 10% for its employees and B contributes 5% for its employees? Yeah. But I'm either going to have to use restructuring to test that plan, or it's a general tested plan. Before I can get into the nitty-gritty of coverage and non-discrimination testing, I have to figure out who's an HCE, and that also is impacted by my related employer status. If I am a 5% owner of any related employer, and I'm an employee of any related employer, I'm considered an HCE with regard to them all. So Company A owns 90% of Company B. This is a parent sub-controlled group. But the other 10% of Company B is owned by Mary, who is an employee. I don't care whether she's an employee of A or B. They're a controlled group. They're one employer. So she is an employee, and she owns 10% of the subsidiary. That's it. She is an HCE, and she is an HCE as to both companies. Or you can be an HCE by virtue of compensation. And to do that, all right, $120,000 threshold these days, to do that, I'm going to aggregate all the compensation from all related employers. And I see a typo on the screen here. Chris works for A and B. Each pays her $70,000. And A sponsors a plan covering just the A employees. And let's suppose for allocation purposes, the A plan just says we're going to look at your A comp. For purposes of testing whether she's an HCE, she has a comp of $140,000 between the two companies. She is an HCE as to both. Now, unless you're using the top 20% rule. The top 20% rule, when I've got related employers, is going to look at all employees from all employers, whether or not those related employers sponsor the particular plan. It's all one company as far as the related the retirement plan rules work, and that includes the HC rules. So I'm going to count organization-wide, the entire related employer group-wide, to see how many employees I have, and I multiply that by 20% to get my top 8 group. I will then line up, on a spreadsheet at least, all of the employees of all those related employers to figure out the top 20%. All plans of all related employers must make the same election with regard to whether they use the top 20% rule. I can't have one of the related employers do it and not the others. Before I launch into the mechanics of coverage and minimum participation per se, do we have any other questions I ought to get to, Tim? I will take silence as that there aren't any, and we'll go on to coverage and minimum participation. Companies A and B are related, and each has a 401k plan covering its own employees. I've eliminated the people who don't satisfy the minimum age and service requirements, and any other excludable employees. And you see the chart here. And now I test these plans for coverage. How many non-Hileys are benefiting from the A plan? And from the internet comes a resounding reply, 6, right? We're benefiting 6 out of how many non-Hileys? I am amazed when I give this as a live program how many people answer, you're covering 6 out of 6 non-Hileys. Well, that would be true if A were on its own, but it's A and B together. And I'm testing the plan separately, at least at first. The A plan covers 6 out of 20 non-Hileys. It is covering 30% of the non-Hileys. Let me make a side note here. Suppose I have different eligibility requirements between the two plans. When I'm testing the A plan, I'm using the eligibility requirements for the A plan. When I'm testing the B plan, I'm using the eligibility requirements for the B plan in computing who are my excludable employees. And the answers might be different depending on the facts. In any event, let's keep them with the same eligibility requirements just to keep things simple. We're covering 30% of our total related employer non-Hileys in the A plan. What percentage of our Hileys are we covering under that plan? 40%. We're covering 30% of our Hileys, 40% of our non-Hileys. We've got a coverage fraction of 75%. Do we pass the ratio percentage test? Yeah, the A plan is good to go. Let's look at the B plan. How are we doing on non-Hileys in the B plan? Well, we're covering 14 out of 20. That's 70%. Hey, they passed the ratio percentage test too. I don't have to go any further. A note, this is not an unusual result. There are a lot of times when people have come to me and say, well, A and B are related employers. We just found this out, and we never counted the B employees. And I said, okay, let's rerun the test and see if you pass. And they do. Because not only are you excluding the non-Hileys from Company B, you're also excluding the Hileys from Company B. And those Hileys are helpful in terms of testing just the A plan. And frequently, not always, frequently, you end up with both plans passing. But again, not always. When take a look at the screen, I've got the coverage fractions that are ultimately there. 75%, 116%. One of the nice things about our target being 70 percentage point is it gives us some leeway. It gives us some wiggle room and fudge factor for things to work out. If the required coverage fraction were 100%, it would, or 90%, it would be a much tougher game. It is far more reasonable having it there at 70%. Congress has structured it in a way to make it reasonable to be able to pass. Let me change the facts. Companies A and B, related employers, are going to buy Company C. So Company C joins the family. The employees of Company C don't have a plan. Oh, and they are excluded from the A and B plans. Oh, so we go back and test it again. Let's see. The A plan is now covering 6 out of 30 non-Hileys. The A plan is covering 20% of the non-Hileys. It's covering 4 out of 12 of the Hileys. That's 33 and a third. 20% divided by 33 and a third is 60%. We fail the ratio percentage test. So what do? What possibilities exist? One possibility is to amend the A plan to cover some of the C employees. B employees have their own plan. We'll amend the A plan to bring in some of the C employees. And that's perfectly legal. I don't have to go to the IRS for their blessing on this. This is a retroactive corrective amendment. What's my deadline to do the amendment? You've got the right answer if you say 9.5 months after the end of the year. Suppose it's a calendar year plan. What's 9.5 months after the end of the year? I ask this question because I'm amazed how many people say September 15. No, that's only 8.5 months. 9.5 months is October 15, a day that will live in infamy, the one that we should know. all right, bring in the C employees, or we pass the average benefit test, or we permissively aggregate the plans. Now, if we, all right, this is, C doesn't have a plan, but we permissively aggregate the A plan and the B plan, and all the things we talked about with permissive aggregation apply, we're covering 20 out of 30 non-Hileys, so we're covering 67% of the non-Hileys. We're covering 83% of the Hileys. We pass on a permissive aggregation basis. The way I would go through these options is I would first go and see if I can pass the average benefit test. Failing that, then I would look at permissive aggregation. And unless we, if we can do permissive aggregation and we pass with permissive aggregation, life is good. And it's only after I've spent all of those bullets and not gotten through that I look at bringing some additional employees into the plan, because that, of course, costs money, where the others are just a matter of mechanics. Hello, Tim. Yeah.
The bullet says, what can A do? There might be another bullet that might read, what must A do? And that is, if the A plan had a fail-safe in it, you would have to follow the fail-safe, wouldn't you? And these other options would not be there for you?
This is true, but what does that fail-safe do? The fail-safe says, if I've excluded somebody from an allocation because they didn't satisfy the last day requirement or the 1,000-hour requirement, I bring them in. Now, maybe you had it in your documents, but my documents never had a fail-safe for if I had some other exclusion, like Company B employees aren't eligible to participate. I've never seen a fail-safe that would bring them in. The fail-safes are designed to deal with the situation where you have an allocation condition, such as last day or 1,000 hours, and that indeed, if you have checked that particular box, yeah, you got to bring in the people through that. But I haven't seen a fail-safe, and maybe you have, that would bring in people that are excluded on some other basis. But I think that's an extremely important point. Let me go back up to the prior example for just a moment. I'm sitting there at the beginning of the year and saying, well, look at these numbers. We're going to pass. Life is good. And then you have an employee at Company A who leaves mid-year and doesn't receive an allocation as a result, and the plan that you started the year thinking you were going to pass fails by the end of the year because of your plan's allocation condition. And for that, the fact that you had checked that box would be very material. You would have to bring in that employee in order to be there. Would you like to add something, Tim?
No, I think that covers it nicely. The point is, the first thing you have to do is read the document.
Absolutely true. Absolutely true. Let me add a quick pet peeve. I am astonished at the number of times I've had people come to me with control group related employer questions. And I've gone back to them with, what does the document say? And the response I've gotten is, well, I don't have the document, but I've got this check sheet, and I stopped them. I don't care what your check sheet says. I want to know what the document says. And if you don't have a copy of the document, give me somebody who does. I want to know what the document says. And sometimes these can be fairly arcane clauses. Just looking at the fact that you have a check mark in an adoption agreement really isn't going to answer the question. Let me see the document. And you just can't work off of check sheets. All right, let's do the average benefit test. Now, I'm going to keep it simple for right now, make it just a straight profit sharing plan. And to keep it simple, the employees at Company A all receive 10% of comp. The employees at Company B in a separate plan, mind you, all receive 6% of comp. The employees at C got a hearty handshake at the end of the year. To do the average benefit test, the first thing we have to do is the non-discriminatory classification test, which for coverage has two parts. The first is there has to be a reasonable objective classification. In this case, classification of what? Classification of why you're in or out. Well, in this case, if you're in Company B or C, you're out of the plan. If you're in Company A, you're in. Is that a reasonable objective classification? Absolutely. There's no question of that in my mind. It certainly is not discretionary. I look at the employee. I look at where their paycheck is coming from. I look at what a company is responsible for them, and I say, yeah, that's the employer. There's no discretion. Is it reasonable from a business standpoint? Absolutely, no question. So that works, but I also have to have my coverage fraction be at least equal to, ideally, a safe harbor percentage. Failing that, it has to be at least as good as an unsafe harbor percentage. And I have facts and circumstances on my side. I hate arguing facts and circumstances with the IRS. Give me the safe harbor. All right. In order to figure the safe and unsafe harbors, I have to figure out the concentration percentage of the employees. The concentration percentage is the percentage of employees that are paying attention at any given time. Those that are at the water cooler are not included. No. The concentration percentage is the percentage of the plan participants that I said that wrong. The percentage of non-excludable employees that are non-Hileys. So in this case, I would compute that percentage company-wide or related group-wide. So I've got a total of 42 employees, 30 of whom are non-Hileys. If memory serves, that's around 71, 72%. You'll look it up on the table, and my safe harbor number is 41.75. I calculated earlier that the A plan has a coverage fraction of 60%. We're covering 20% of our non-Hileys, 33 1/3 of our Hileys. Coverage fraction is 60%. That's at least equal to 41.75. Great, we satisfy the numerical non-discriminatory classification test. Now we go into the average benefit percentage test. For the average benefit percentage test, we look at all plans the employer maintains. Well, that includes the Company B plan because it's all one employer, right? So I've got 6 non-Hileys at Company A who are getting 10%. I've got 14 non-Hileys at Company B who are getting 6%. And I've got 10 non-Hileys who are getting diddly squat. So 60% plus 84% is 144 percentage points divided by 30. My average non-Hiley is getting 4.8%. Now I do the same type of calculation for the Hileys, and my average highly is getting 6.33%. I divide 4.8 by 6.33. I get a fraction of 75.83%. That's at least 70%. We pass the average benefit test. So the A plan passes. It doesn't pass ratio percentage, but it does pass the average benefit test, and we're good to go from there. Minimum participation only applies to defined benefit plans. It requires that you cover the lesser of 50 employees or 40% of your non-excludable employees. And once again, we're counting this throughout the related employer group. So suppose I have a clinic with 6 non-highlies, and it's in an affiliated service group with 3 doctors. Each of the 3 doctors is separately incorporated. So I've got a partnership, and I've got 3 PCs. I've got 3 highlies and 6 non-highlies between the whole shooting match. So I've got a total of 9 employees. I've got and one doctor, it's always a doctor, one doctor wants to have a DB plan. 40% times 9 is 3.6. I never want to meet 0.6 of an employee. So I have to round up, it's 4. So in order that one doctor cannot set up a DB plan unless it covers at least 4 people. Now, presumably, that could be 3 doctors and one of the employees over at the clinic. And then I'd set up some other defined contribution plan for the other employees and permissively aggregate the plans and, provide a minimum gateway in the DC plan. I can do all that. But the point is, I'm not going to even get there without covering at least 4 employees. And the related employer rules count in doing this. Alternatively, we could cover the 1 doctor and half of the non-highlies over at the clinic and leave the other 2 doctors out of that plan. They can sponsor their own plan. That's another perfectly legitimate approach. But we need to we've got to do something to get to that point. Any new questions come in, Tim, that you'd like to throw at this point?
Not really about the 401A26, but there are some questions that maybe indicate that we weren't careful about, well, not careful, but we didn't really cover it clearly enough. And it just really deals with who is an excludable employee. You have eligibility of 3 months of service. For coverage testing, can you also exclude those employees who have not completed 1 year of service and attained age 21?
So, we've been talking about permissive aggregation. There's also the possibility of permissive disaggregation. So I could have a plan that has a 3-month eligibility requirement, and I can test based on everybody who satisfies that 3-month requirement. Alternatively, I can say we're going to essentially have 3 groups of people. Those who don't have 3 months and therefore are completely non-existent. Those between 3 months and a year who are in the otherwise excludable category, and then the upper group people, the folks who have a year of service and have attained age 21. And one possible strategy for testing is to test separately the upper group, those who have a year of service, have attained age 21, and passed an entry date, test them separately from the lower group, the otherwise excludable group, in this case, the people who are between 3 months and a year, or who haven't attained age 21 but are in the plan anyway. Or who have taken advantage of a daily entry date but haven't satisfied the longest possible entry date that we could have put in the document. We can structure that, those folks would all be in this otherwise excludable category. We can test either based on the plan as a whole, so 3 months and up, or split it into those two groups. But let's suppose we do the otherwise excludable testing. Perfectly legitimate choice. I have to test the upper group plan, and I have to test the lower group plan. When I test the lower group, the folks who are between 3 months and a year, I'm still going to add all the employees between 3 months and a year at Company A and Company B to get my denominator. And that means that that lower group plan isn't necessarily going to be a slam dunk unless all of the folks in that category happen to be non-Hileys. But if the boss's kid was hired someplace and is an HCE by virtue of attribution, which certainly can happen before they have a year of service, that could create a problem with the lower group. Would you like to add something, Tim?
No, I think that covers it nicely. I would like you to comment on what happens when you're doing permissive ag and the two plans have different sets of eligibility rules. I think you mentioned in passing that you look at the most favorable set, and let me give you a fact pattern here. Plan A, the eligibility is 6 months of service and age 21. That's 6 months, age 21. Plan B has 1 year of service and age 20. Who are the non-exclutables in that plan based on age and service after aggregation?
If I permissively aggregate the two plans, test them as a single plan, the folks that I can disregard altogether are those, let's ignore the otherwise excludable rule. This is, I'm just trying to find out who are the employees that have to be in the coverage test. You're in the coverage test if you meet the eligibility requirements for either plan. It isn't the lesser of the age and the lesser of the service. It's I can meet the eligibility requirements for either plan. So I either have a year of service and have attained age 20, or I have 6 months of service and have attained age 21. But if I can meet the requirements of either plan, I have to be counted in testing. Now, if I want to take the additional step of testing on an otherwise excludable rule basis, there I don't see that I particularly have any choices. There, my dividing line established by statute and by the regulation is age 21, 1 year of service, pass an entry date. And I don't have a choice. That's hard-coded in the regs. Now, I have seen documents that handle it differently, at least in terms of the ADP test. If your document prescribes what you do, follow your document. Other points?
This is an interesting question, and there's actually a couple points here. Under the average benefits test, if there are no employer contributions, and we'll read that to be non-electives, if there are no non-electives to the plan year for all the plans, does the plan fail the average benefits percentage test?
The interesting thing is the average benefit percentage test takes into account all contributions other than voluntary after-tax employee contributions. But it takes into account deferrals, it takes into account match, it takes into account non-elective. So if you have, for example, if this plan where I did the average benefit test had a non-elective contribution shown under the allocation, but it also had elective deferrals, the calculation isn't going to be nearly as easy as I show on the screen. What I'm going to have to do is either have software or have a spreadsheet, and I'm going to add together, when I calculate the average benefit, all of your deferrals, both Roth and pre-tax, all of your match, and all of your non-elective. And I do that for each employee in calculating these fractions.
Okay, here is another interesting question on the average benefits test. On the average benefits test, in the sample that you showed here, we just use percents of contra on current contributions. Could you also do age-based testing?
Absolutely correct. And so could, instead of dealing with allocations, could I use E-bars? Absolutely. Absolutely.
Okay, could you use age? Okay, let's say that you had a safe harbor allocation plan, and you're not testing the non-electives on an age-based or on an age basis. Could you just do the average benefits on an age-based?
In other words, even if I don't test nondiscrim on the basis of age, I test nondiscrim on the basis of compensation.
Yes.
Could I test coverage on the basis of age, tested on a benefits basis? Yes. Okay. I can separately test and make separate elections in terms of testing method for coverage and for non-discrim.
Thank you.
One of the great things that we've got is a coverage transition rule that I like to call the free pass. It applies whenever you have a change in a control group. This could be somebody coming into a control group, somebody leaving a control group, a change in membership in a group. It also applies to mergers, stock deals, acquisitions, and the like. There are people who look at the reg and say, oh, this is just for mergers and acquisitions, not for a change in ownership that would result in a control group. No, you look at the statute, it applies to both. So it applies to changes in control groups and to mergers and acquisitions. If I have a plan in place before the transaction, and it satisfied coverage and minimum participation without regard to the coverage transition rule immediately prior to the transaction, I've got a free pass of coverage. Not only coverage, but also minimum participation. Notice what is missing from the screen. I do not get a free pass of 401A4. I do not get a free pass of non-discrim. I get a free pass of coverage and minimum participation. During a coverage transition period that starts on the date of the transaction and runs until the last day of the following plan year. So if it's a calendar year plan, for example, and I buy Tim's business. Are you for sale, Tim? No. I buy Tim's business today, and my plan passes coverage today. I go and buy Tim's company. I have a free pass of coverage until December 31, 2018, unless, bottom bullet, there's a change in coverage or benefits during the transition period. If there is a change in coverage or benefits, I modify the plan, I modify what I'm doing in such a way that it affects coverage or benefits. Boom, I have blown the coverage transition period from that day forward. Let's try an example. Solo has a defined benefit plan. The plan specifies that the only employees of the plan, the participants of the plan, are the employees of Solo. Solo has 10 employees, and they're all in the plan, 5 Hileys, 5 non-Hileys. Everybody loves the plan. The plan's doing wonderfully. It passes coverage. It passes minimum participation. Everything's good. Calendar year plan. Until February 16, 2017, when Bosco buys 80% of the Solo stock. At that point, they become a control group. They become a control group on that date. And there's no delay in the fact that they are a control group. In fact, suppose you had somebody who was a participant in the Solo plan and a participant in the Bosco plan, and they were both defined contribution plans. Boom, suddenly that person has a single 415 limit, where before they might have had 2 separate limits. Now they have 1 limit. So the control group is formed immediately. Bosco has 500 non-Hileys, 28 Hileys, all of whom are excluded from this great little defined benefit plan. Solo doesn't amend the plan. Solo has a free pass of coverage and minimum participation that will take them through 2018. Lovely. Let me do a couple of things. Suppose Solo decides to amend the plan January 1, 2018 to increase the benefits. They say, well, obviously Bosco is going to be terminating this plan before the end of the year because, you know, by the time 2019 hits, this plan ain't going to pass anymore. So if we're going to go down, let's go down in a blaze of glory. Let's up the benefits to the 415 limit. The free pass ends immediately. And the plan clearly fails at that moment minimum participation and will likely fail coverage. Tweak number 2. Suppose the Solo plan, by its terms, automatically covers all controlled group members. I've seen them. I have one on my desk right now that's its terms. It automatically covers all control group members. The instant Bosco bought Solo, all 520 Bosco employees became participants in the Solo plan. And of course, nobody in the course of dealing with the merger bothers to talk to the retirement professionals until after the deal is done. Check the terms before the transaction, because once the transaction has happened, it is too late. If you talk to the benefits professional February 15, and the deal's going to happen on the 16th. On the 15th, they can say, stop, let's amend the plan and make sure it's just the employees of Solo who can participate. Life is good. And if you do that amendment on the 17th, you've just blown the coverage transition rule. It's too late. Which is why one stresses with one's clients, don't do this. Talk to me first. Let's suppose we introduce a bigger fish. Huge Co. comes and buys Bosco January 15, 2018. At that point, yeah, the Solo plan passes coverage in non-discrim. It's good to go until December 31, but the only reason they pass is they're under the coverage transition rule. I can't tack the rule to get myself another year. So the coverage, so even though Huge Co came in, major change in the control group, the coverage transition rule relief is going to end December 31, 2018. Now, one other note. Let's just suppose that this will do. Let's suppose that there was this was a cash balance plan, which is a general tested plan. There is no coverage transition rule for 401A4. Nobody's quite sure what to do with this. There are three possibilities. One is, well, since the coverage rules are used to pass testing, and I've got a free pass of coverage, I get a free pass of testing. I don't have to worry about the general test at all. If you believe that, I've got a bridge in Brooklyn you may be interested in acquiring at a very reasonable price. Possibility number two. Hey, your host, you've got to count all the employees in doing your general test and you're going to fail. The in-between position is, well, if I pass coverage just looking at the Solo employees, then while I'm in the coverage transition rule, I'll pass non-discrim just looking at the Solo employees. I have heard IRS minions at conferences say that that's a reasonable approach. Those IRS minions no longer work for the IRS. It's an informal comment. You can't rely. I think that's a reasonable approach, but it ain't in writing. Let's talk quickly about ADP ACP testing. The coverage transition rule doesn't apply to the ADP and ACP test, but it doesn't really need to, because the ADP test only looks at the employees who are eligible to defer to the plan. Similarly, the ACP test includes only those employees eligible to receive a match. So suppose A sponsors a 401k plan covering its 30 employees, but not the 20 employees of the related company B plan, or in the related company B. The company B employees are not in the ADP test. If I can pass coverage without them, life is good. But one plan means that there's one ADP test. I can't separate out A and B for purposes of doing the ADP test. I can't separate them out in terms of doing the ACP test. So suppose I have one plan with a discretionary match and company A is providing more of a match for its employees than company B is. Number one, there's going to be one ACP test, including them all, since they're related employers. And number two, I'm going to have to check benefits, rights, and features, because there's a different rate of match between the two companies. Interestingly enough, if I've got a highly who's in multiple plans, I'm going to have to aggregate their contributions. Let's make this ADP tested plans. So A and B sponsor separate plans. A will make a safe harbor plan. B is an ADP tested plan. Harry the highly is eligible to defer to both plans, but of course, Harry only defers to the A plan. The B plan has got to count Harry's deferrals to both plans in the ADP test. The same applies to the ACP test. The fact that it applies to the ACP test can blow your ACP safe harbor if you have different rates of match between the two plans. This ADP aggregation rule only applies to Highleys. This says what I just said about it blowing the ACP safe harbor. A little more detail on that. I'm going to skip. And one of the things I mentioned earlier is I cannot combine, permissively aggregate a safe harbor plan with an ADP tested plan. I cannot put the two in a single document. If I want to have an ADP tested plan for one company and a safe harbor plan for the other, it will necessitate two separate documents. If a safe harbor plan has an event that qualifies for the coverage transition rule, change in control group, merger, acquisition, one of the nice things that does is it gives us the ability, if we want to terminate the plan in connection with the change and not lose safe harbor status. So we still don't have to run the ADP or ACP test, and we don't have to give 30 days advance notice. We do have to fund up to the date of termination. The termination has to be in connection with the transaction. This is for a complete termination. It does not apply to a freeze or to a suspension or reduction. If we are exiting, if we are suspending or reducing the safe harbor contributions during the year, even if it's in connection with a merger, acquisition, or other coverage transition rule event, we lose the benefit of the safe harbor. One other thing, if I have a company merger and I have an ADP tested plan, and let's say company A has a current year tested plan and company B has a prior year tested plan, I have the ability to amend one plan or the other and flip it so that both have the same testing method, even if doing so would otherwise violate the 5-year rule that normally applies, that limits how quickly I can go from current to prior year testing. The coverage transition rule doesn't give us a free pass of ADP or ACP, but we don't particularly need it because the only people you're counting are those who are eligible to participate. If you have a plan coverage change and you have a prior year tested plan, you effectively have to do a weighted average of the prior year tested numbers. This is A, complex, and B, boring. But just know, if you have a prior year tested plan, that can complicate things. If you have a simple IRA or 401k, you've got one extra year on the free pass. So the transaction happens today. If it's a simple IRA or 401k, I've got until 2019. If I've got a SEP, there's no free pass at all. That always shocks me. For a 403B plan, to the extent that you're required to do coverage or coverage testing, I can make use of the coverage transition rule there. The 403B plan won't need the free pass for deferrals. Universal availability applies on employer-by-employer basis. Finally, we get to non-discrimination on 401A4. If the plan is a safe harbor plan in terms of non-discrimination, if everybody's getting the same thing, then it satisfies 401A4 regardless of whether all employees are there. In other words, suppose I've got a straight money purchase plan. Everybody gets 10% of comp. And it's just the company A employees are participating, the company B employees are not. If the A employees can pass coverage, life is good. It's a safe harbor plan. I don't have to do anything special on testing a non-discrim. But if it isn't a safe harbor non-discriminatory design, for example, if it's a cross-tested plan, then when I do my general test, I'll have to take into account all non-excludable employees of all related employers, whether or not they're benefiting from the plan under consideration. If I have to do the average benefit test as part of the general test, I will take into account all plans the entire employer group maintains. So here we are back again with A, B, and C, and once again, this time A and B are jointly sponsoring a plan, but have different contribution rates. That's going to make it a general test. The C employees don't have a plan, so we're doing the general test on this plan. We go through and say we have two different rate groups. I've got 4 Highleys who are getting 10%, 6 Highleys who are getting 6%. So I've got 2 rate groups, the 10% rate group and the 6% rate group. And I separately compute the coverage fraction for each group. Looking at the 10% group, it covers 6 out of 30 non-Highleys, 20% of our non-Highleys. It covers 40% of our Highleys. That's a coverage fraction of 50%, which isn't good enough for the ratio percentage test, is just fine for the non-discriminatory classification test. The 6% group covers half of my non-Highleys, 60% of our Highleys. Pardon me, I said that wrong. The 6% rate group includes 21, add together A and B. It covers 21 out of 30 of our non-Highleys. It covers all of our Highleys. Coverage fraction is 70%. That passes the ratio percentage test. So both will pass non-discriminatory classification. I have to do the average benefit percentage test. Oh, looking at the average benefit percentage test, adding what everybody gets, yeah, that's the bottom line number. I fail. I have to count the C employees in determining whether or not I pass the average benefit percentage test. Oh dear, what do I do? Answer, I give some more money to some non-Highly somewhere. Enough that we bring it up and pass. Oh, there are other alternatives, but that's the readiest one to deal with that. There is an alternative approach, restructuring, which allows you to take a plan like this, divide it into separate plans, but each of those separate plans must separately pass both coverage and non-discrimination. The best thing about restructuring is it can allow you to use different testing methods for different groups. For example, I could test the A plan on the basis of allocations and the B plan on the basis of benefits. But if I'm going to test any of them on the basis of benefits, I have to provide a minimum gateway to everybody. Benefits, rights, and features issues can be a problem, particularly if you're permissively aggregating the plans. And it can come up in a bunch of ways. For example, one plan has an early distribution feature, the other doesn't. The plans have different distribution options, all right? I can have two plans that are identical, except the A plan is with Fidelity and the B plan is with Vanguard. The fact that there are different investment options available to the two is a benefits, rights, or features issue. The A plan allows participant direction, the B plan doesn't. The A plan, the definition of comp you can defer out of allows you can defer out of your bonus, your B plan doesn't. That's a difference in benefits, rights, and features that has to be tested. So warning, if you're going to permissively aggregate, you've got to look at just a host of features. I've talked about the coverage transition rule. Let me give you one final example. Company A sponsors a cross-tested plan just for the benefit of its own employees. I've got that on the left side of the screen. Anybody whose name begins with H is a highly. Anybody whose name begins with N is a non-highly. The facts down at the bottom say, hey, this plan passes. In fact, the average benefit percentage test is wonderful, 192%. Thank you, Nadia. We love you. Nadia is a very young employee, and golly, she's useful. But you later find out, so you've got this set up and everything's great, and then you find out, oh, there's another company B you didn't take into account. Well, the company B has another highly, Harry the highly, and 6 other non-highlies. So this plan that you thought was covering everybody is covering, in fact, only 4 out of 10 non-highlies. 40%. But it's only covering 50% of your highlies. So you pass coverage with an 80% coverage fraction. That's good. But I have to take into account everybody group-wide in doing my cross-testing analysis. Look at all the things that are different between the two. Instead of the 3.78% rate group covering 50% of the non-highlies, it now covers only 40% of my non-highlies. But it covers only 50% of my highlies. That's still good. Notice my midpoint number, my target I'm looking for, is different because I have a different concentration percentage counting all the employees. My average benefit percentage test changes. It would be easy to come up with an example with Nadia being a little bit older where I pass the average benefit test looking at a average benefit percentage test, looking at company A alone, but I would fail looking at A and B together. But the point is, when you're doing the general test, you have to take into account all employees of all related employers. I am sure there are a lot more questions. We will be posting answers to all of them, and I'm going to do my best to get them for you next week. But I've gone a little bit over, and I think I probably ought to turn things back over to Chuck.
Thanks, Darren. Yeah, I was tough with all those questions, and there's still a lot coming in. It's tough to stay on schedule there, I guess. By the way, folks, I forgot failed to do the introduction of Darren. So if without me boring and reading it to you, you can also go to his employerbook.com webpage and read about Darren. He's also on our homepage under our Aristopedia team. We've got his bio there. But we appreciate it, Darren. Great presentation. And please, we'll keep track of all these questions, folks, and try to get answers back to you. If you can hang around for another minute or two, we're going to give you a quick look at Darren's Who's the Employer title that's now on Aristopedia.com. If you can't stay online, or if you can and you'd like a personal demonstration, we can do that at your convenience. Just let us know. Thanks again. We're going to start with a demo here in just a minute. By the way, also, your continuing education credits will be sent to you shortly. Usually it takes a few days for the ASPA and NIPA credits. The IRPA takes a little bit longer. So hang online here for a few more minutes if you can, folks, and we'll do a quick demo for you. Okay, so on the Aristopedia.com website, we have our qualified plan eSource, obviously, that's our sort of our main product, but we also have a number of other titles that are available optionally. And Who's the Employer, we're really happy to say Darren's 7th edition is now available exclusively on Aristopedia. It's the same concept and organization as he's had in print for years, and as well as I think you had an electronic rendition of it too, Darren. But it's broken down in chapters. It is still Q&A oriented, so you can read the questions in the table of contents. You can quickly see where, what the different questions are, scope through, find one that's on point, go right to it directly. You'll see that it's also footnoted with plenty of code and regulation links, and even interlinked to other chapters inside the title. So, Chapter 10 has a lot of things about the effects of a related employer status, and obviously Chapter 23, entitled Coverage, is going to have a lot of questions and answers based on a lot of what we talked about today. On Aristopedia.com, you can always search the title by just simply checking the box, going to a search expression template, and typing in something like key employee, if I could spell right. Click search, and you'll see that it'll find every time that phrase is used inside of Who's the Employer, and obviously it takes you right back to Chapter 24, which is a lot about key and highly compensated employees. So that's what it looks like on Aristopedia. We'd be glad to set you up with a free trial or give you a more detailed demonstration. You can always contact us at either sales@aristopedia.com or support@aristopedia.com. Or you can simply go to our homepage, Aristopedia.com, and go into all the different little pages where we have our webcast, where the recording of this as well as the slides will be available. We have information about our products. You can find out about our authors. We have a blog that various authors are posting to periodically. All of our pricing's there, and you can sign up for free trials or go ahead and buy a subscription. Thanks for your time, everybody. We appreciate it and hope you have a great day.